Okay, let's take a look at this interperiod income tax problem. It's exercise 19-8, and it deals with multiple temporary differences. Vickers Company reports taxable income of $4,500 for 2010. The company has two temporary differences between pre-tax financial income and taxable income at the end of 2010. The first difference is expected to result in a taxable amount totaling $2,470 in future years. The second difference is expected to result in deductible amounts totaling $1,360 in future years. The company has a deferred income tax asset of $372 and a deferred tax liability of $690 at the beginning of 2010. The current tax rate is 30% and no change in the tax rate has been enacted for future years. The company has positive verifiable evidence of future taxable income. And we're asked right here to prepare the income tax journal entry for the Vickers Company. Okay, so what I did is I staged this problem so we can make some sense out of it and follow the logic clearly. We've got a deferred asset on our books, right, of $372. Show that as a debit. The deferred tax liability is $690. That's given. And they tell us we've got deferred tax amounts of $2,470 and future deductible amounts of $1,360. Well, the first calculation, or what do I know I'm going to have? I know I'm going to debit income tax expense. I don't know the amount just yet. And I know I'm also going to credit income taxes payable. Right? I mean, we know we're going to have that entry. Don't yet know the amounts. But I think the income tax payable is the number to start with. It's the easiest one. We take the $4,500 of the income tax of the taxable income times the 30% tax rate. Right? And that gives us $1,350. Now, that is what we absolutely know we're going to pay in taxes in the current year. Okay, now it gets a little bit more complex because we've got to think through both temporary differences. Well, we have deferred tax amounts of $2,470. The tax rate is 30%, so if I multiply those two, and you see I do it right here, K19 times K20, or you can look up here, I come up with $741 is essentially where I want to wind up in my deferred tax liability, because our new calculation says, based on this, we think we're going to be at $741 at the end of the year. Well, if that's the case, then that difference has to be a credit equal to the $741 less the $690, which is $51. So I know I need to increase my deferred tax liability so that I wind up at the end of the year equal to that $741. And to do that, I'm going to have to credit it for $51. Okay? Next, we look at the future deductible amounts. Well, future deductible amounts with $1,360 times 30% gives us $408. Again, we just multiply K23 times K24. You can see the formula here or up here. And that says we're going to wind up with a deferred tax asset at some point in the future equal to $408. Well, at this point, we know it's $408. That's what we have to get to. So, following the matching principle, we know then that the difference is what we're going to have to increase that deferred tax asset. We're going to have to come up with what that difference is. It's 408 minus 372, so we have another increase of $36. And that $36 would be my deferred, my tax asset. Increases by that $36. Once we know that, once we know exactly what the balance sheet should look like, meaning the current liability of $1,350, what deferred taxes should look like and what deferred tax assets would be, then we can force the income tax expense, which is going to be equal to, the sum of the debits, obviously, minus the credits. Because it'll balance. But the other way you want to think about this, if you don't want to think about forcing it, is you know that the income tax expense is going to be the net impact of the taxes we pay this current year, plus or minus the net change in what happens to our deferred tax liability account and our deferred tax asset account. And that's the entry we need to make. And that's this problem.